Hello, my name is Anthony Siccaro. I'm founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer, and that's a Southern California radio station. The purpose of this video today is to talk about the difference between investing for growth or investing for income. There's a lot of confusion when we talk about growth versus income, and yet if you're invested for income, but you look at your statements as if you're invested for growth, you're going to be really confused. And the reality is that income producing investments versus growth investments, they react differently to different circumstances. Growth investments tend to react more to the stock market, whereas income investments tend to react more to the interest rate environment. So sometimes people are invested for income and they see the stock market going up and they wonder why their portfolio is not going up. Well, it's because they're not invested in the stock market. They're invested for income. So I want to just take some time and I want to flesh that out and make sure you understand the difference between the two investment strategies. There are two different philosophies, two different fundamental ways of investing, and it's important that you understand not only which way you're invested, but what factors are going to affect the performance of your portfolio. So let's talk about investing for growth. When you're investing for growth, you're buying a stock or a mutual fund or something that you're hoping grows in value. You buy something at $10 a share, you want it to grow to $20 a share, right? Of course, no one ever buys anything at $10 a share hoping it goes down. But sometimes that's what happens. Growth doesn't always happen. Sometimes it does go backwards. So when you're investing for growth, the performance of your portfolio is going to depend on the share price. It's going to grow. If it grows, it makes money. If it goes down, you lose money. On the other hand, when you're invested for income, you're not investing for the share price to grow, and you certainly don't want it to go down. You're investing for the consistent interest and dividends that are coming in. And there's a whole universe of options out there that are designed to protect your principal, keep your share price relatively constant and within a tight range, and then give you consistent interest and dividends. And that's why you invest for income. Now, when you're invested for growth, is there any guaranteed interest or dividends when investing for growth? And the answer is no. You might get some dividends from your mutual funds, you might get some dividends from stocks, but that's not guaranteed. They can change that at any point in time, and you may not be able to count on it. And even if you were getting consistent income, you're probably getting less than 2.5% across the board in your entire portfolio because there are just not a lot of high quality companies out there that are paying a decent rate of return. On the other hand, when you're investing for income, our goal for our clients is to help them earn a 4 to 7% consistent rate of return, but without the risk, without the volatility of the stock market. And there are some investments in here that correlate somewhat to the stock market, but there's a lot of investments in here that have nothing to do with the stock market, but still provide you a more consistent rate of return. And that's our goal when we're helping you invest for income. So let me draw on the board just an illustration of how this works. Let's say that you invest $100,000 for growth and that you also invest $100,000 for income. Okay. Well, as we talked about earlier, when you invest $100,000 for growth, the performance of your portfolio is going to depend on the share price. So if the share price doubles, then what happens to your $100,000? Well, it's going to double. But doubleage doesn't always happen, right? It may go backwards. You could also lose half your value as well, too, when you're invested for growth. So there's a lot of volatility when you're invested for growth, which is just the nature of the game when you're invested in stocks or mutual funds or other investments where the performance of your portfolio is dependent on the share price. On the other hand, when you're invested for income, you're not investing for the share price to grow or for the share price to double. It's not going to. And you're certainly hoping it won't be cut in half. And when you're investing for income, if you're not investing for the share price, then what are you investing for? Well, you're investing for the consistent dividends and interest. And again, our goal is to help our clients at this stage, at the end of 2016, earn a 4 to 7% rate of return, but without the risk of investing for growth. And it doesn't mean that you're going to average 4. It doesn't mean that you're going to average 7. But the different investments we talk about range in that range as far as interest is concerned or dividends are concerned. So let's just say that your portfolio is averaging 5%. So if you have $100,000 that's averaging 5%, then what's going to happen is you're going to be getting a consistent $5,000 per year of income. $5,000 per year of income. And you can take that income and you can spend it. And if you spend it, then you're not having to sell shares. And if you're not having to sell shares, then you're preserving your portfolio. Or you can take that income and you can reinvest it. And if you reinvest it, then your portfolio should get larger the old-fashioned way over time because you're just reinvesting the interest and dividends that you're not spending. Now, it doesn't mean that there's not going to be any volatility over here. There's going to be some level of volatility. But the range of volatility here is much more narrow than the range when you're invested for growth. So when you're invested for growth, your portfolio could double, could also be cut in half. When you're invested for income, a 10 or 15% move either way is a really big move when you're invested for income. Now, it doesn't mean it can't go beyond that. There's still risks that are involved, but our goal is to keep your portfolio within a narrow range while getting you that consistent income. Now, the income theoretically should stay the same, but as different investments get called, as we continue to upgrade your account and buy different investments for you, then that means that your income is probably going to change slightly. But it's not because the income is necessarily changing for each investment. It's just that in your portfolio allocation as a whole, there might be different investments changing. But our goal is to keep your income constant. So regardless of the fluctuation in your share price, the income's going to stay the same. And if you're spending that income because you're retired and you need the money to live on, let me ask you, what's more important stays the same? Is it more important that your portfolio stays the same 100% of the time? Or is it more important that the income you get to spend every month and every year stays the same? Of course, the income is the most important part of that equation, that it stays the same. Now, what if you're not retired? What if you don't need the money? Well, then what we can do is we can take that income and we can go ahead and we can reinvest it and buy more shares. So over time, your portfolio should grow, but it's not going to grow because the share price is growing. It's going to grow because we're buying more shares. So hopefully that makes sense. Now, if we use this $5,000 and we buy more shares, aren't we now going to be earning a hypothetical 5% rate of return on that $5,000 as well? Absolutely. So 5% of $5,000 is $250 a year, which means that your income went from $5,000 to $5,250 over that time period. Now, it doesn't matter what the fluctuation, what happened to the portfolio value along the way. Your portfolio value might have gone up and your income went up. But your portfolio value could have gone down, but your income still went up because you're getting paid via a contract. So if you're living on your income, and it's really not that important that the portfolio stays the same, what is important is that your income stays the same or goes up every year so you can adjust for inflation. And that's exactly what we help our clients do. But sometimes if you get a statement in the mail and it shows that your portfolio is down, it can be very misleading. And I'm going to explain that a little more in a minute. But it is possible that the total performance of your portfolio might go down a little bit, but the income goes up a little bit. Think about it like this. One of the mistakes that we see a lot of people make is that they look at their portfolio every day or every week. And if you're invested for income, that's a mistake. You're getting the consistent dividends and interest. And it takes time for those dividends and interest to be coming in. On $100,000, if you're getting 5%, that's $5,000 a year. And so it takes time. You need to give it time. Think about it this way. Think about a mortgage. A lot of you have had a 30-year mortgage at some point in time in the past. And when you have a 30-year mortgage and you're making that mortgage payment, say it's $2,000 a month, does it really matter what the value of your home is as far as the payment is concerned, or does that payment stay the same no matter what? Of course, the payment is the same. It's $2,000 a month. Do you look at your home value every single day to see, oh my gosh, where's my home value? It doesn't matter because you're not going to sell your home. Now, if you do have to sell your home, that's the biggest issue. But the reality is that if you don't sell your home, then does the fluctuation of your home price matter, and does it change your payment? And the answer is no, it doesn't matter, and it doesn't change your payment. And that's the same thing here. If you have $100,000, it doesn't matter the fluctuation. If you're not having to sell shares, and if you're living on the interest and dividends, or you're reinvesting the interest or dividends, it doesn't matter what that short-term fluctuation is. And I think that's very important to understand. And I want to take that concept just one step further, because I want to just make sure that you understand the difference between the share price and the income. With many investments out there, especially with the investments that are designed to give you income, you've got two dynamics at play. You've got the share price and you've got the interest and dividends that are coming in. The share price is going to fluctuate, but the interest and dividends are going to remain the same. So if the share price fluctuates up, your dividends and interest are the same. If your share price fluctuates down, your dividends and interest are going to remain the same. So you've got those two dynamics happening at the same time. And when you combine them is when you get total return. So let's say you're making 5% dividends and interest. And let's say that the share price grows by 5%. Well, if your share price goes up 5% and you earn 5% interest and dividends, that's 10% in that year. So you have a total return of 10%. And we've had a lot of clients that have done that have gotten 10% in 1 year, and they're very happy. But you got to be very careful, because the share price is going to fluctuate. Just because it went up 5% doesn't mean that it's not going to come back down. We're not investing for the share price. We're investing for that consistent 5% interest. And if your share price happens to go up, then that's just kind of a bonus. But on the other hand, you could invest and your share price might go down by 5%. And if your share price over a year goes down by 5% and you've earned 5%, then your portfolio could be worth the same thing in 1 year as it is right now. Why? Because they offset each other. Your share price went down 5% and your income offset that, the income of 5%. But again, that doesn't matter. Your share price is going to fluctuate along the way while we're consistently investing for income. And what goes up will probably come down, and what goes down will probably come up, and there's that fluctuation. So you don't want to be too quick to look at total return. Total return is the wrong indicator to look at when you're invested for income. Yet, that's what most everybody looks at. Why? Because when you're growing up in this world and you have retirement plans and you're in the stock market and you have mutual funds, there's only one number that matters to you, right? It's the bottom line. It's the total return number. But when you're invested for income, the number that matters, for all the reasons we talked about, it's not the total return. It's how much income you're getting. And if we left the total return the same, but the income went up every year because we're reinvesting, that's a great way to invest safely. And if you invest long enough that way, then eventually your total return and your portfolio is going to grow because you're continuing to reinvest your portfolio. So hopefully that makes sense. And let me share one particular investment with you that I think will just kind of tie everything together. We've talked about total return, we've talked about share price, we've talked about dividend. And I want to use an example of one investment, a bond, to kind of just illustrate this. Now, we're going to talk about a bond, but this is a pretty good representation of all the different income-producing investments. Now, there are some variances, there are some differences, and we need to have a conversation about what those differences are if you are invested for income. But I think if you understand how a bond works, which is an income-producing investment, then you'll have a good idea as far as how the other investments work as well. So let's talk about a bond. When you buy an individual bond, you get two very important guarantees. You get a guaranteed interest rate, and you get a guarantee that at some point in the future, called a maturity date, you're going to get all your money back. A guaranteed interest rate and a guarantee that at some point down in the future, called a maturity date, you're going to get all your money back. So let's put an example. Let's say that you buy a 10-year bond for $100,000, and let's just say that it's paying 4%. Okay? Now, when you buy $100,000 worth of bonds, what you're actually doing is you're actually buying 100 bonds at $1,000 each. The par value of a bond is $1,000, at least that is for most bonds. So if you invest $100,000 in bonds at par value, and you're earning 4%, let's say, then that means that you're going to be getting $4,000 per year. based on your $100,000. Okay? So $4,000 a year, and you're going to consistently get that $4,000 year after year after year until the bond matures, at which time you're going to get the par value return. So you're going to get your principal returned if you bought the bonds at par value. And by the way, that certainly depends on whether the entity is still around. All of these investments that are designed to pay you consistent income should be high quality investments. You want to make sure that they're going to be around, because if they go bankrupt, then guess what? You may not get your principal back. So it's important to understand that too. So assuming that the issuer of this bond doesn't go bankrupt, then at the end of 10 years, you're going to get your principal back. But between the time you buy the bond and the time the bond matures, the value of that bond is going to fluctuate. And there's a lot of reasons why bond values fluctuate, but one of the biggest reasons has to do with interest rates. And some of you might know that bond values fluctuate opposite of interest rates. So if interest rates go down, bond values go up. And if interest rates go up, bond values go down. And I don't want to take time to extrapolate why that works that way. If you're interested, we have a bond versus bond fund video. You can go onto our YouTube channel and watch that, and I explain exactly why that works that way. But just know that that's how it works. So when you invest in a bond today or anytime, it's important to know where we are in the interest rate environment. And right now, where are rates? Are they high or are they at historic lows? They're very low. So over the next 10 years, where are rates likely to go? Well, they can't go any lower, and I think there's an argument that they might stay the same, but they might also go up. So somewhere between their current level and higher than their current level is probably what's going to happen in the next 10 years. They're probably going to stay the same or go up. If they go up, what's going to happen to the value of any bonds that you own? They're going to go down. Why? Because bond values act opposite of interest rates. Rates go up, the bond value is probably going to go down. But if the bond value goes down, what happens to your income, that $4,000 a year? Well, some of you are going to say that the income goes down too. Well, that would be incorrect. The income doesn't go down because the contract that you have with the bond issuers, that they're going to pay you the same income regardless of the value of the bond. It's kind of like that mortgage. You have a contract with the mortgage company that you're going to pay the same mortgage payment regardless of the value of your house. It's the same thing. So regardless of the value of your bond, the income is going to stay the same. And the value of your bond may go down in value, but the income stays the same. Now, when you get your statement, if you have all bonds in your portfolio and you look at your statement and the bonds have gone down in value, you might say, oh my gosh, what's happening? I lost money. Well, you didn't really lose money because your income is staying the same and you're not having to sell shares. And when the bond matures, you're going to get par value back anyway. And if you bought your bond portfolio par value, then you're going to get all your money back at that point. So really, it's just a paper loss. It's not a permanent loss unless you have to sell. And I think that's just a very good example of how all the different investments work. If the stock market goes up, that doesn't affect your bond. Matter of fact, if the stock market continues to go up as it has here in 2016, and I think we got a lot of problems ahead. I don't want to deviate down that road. You can watch some of my market updates and you can see where we think the market is going to go. But if the market does go up, then what that means is probably interest rates are going to go up too. We've already seen that, just kind of a token raise from the Federal Reserve. But if interest rates go up, then the value of your bond might go down. And if you're looking at your total portfolio and you're forgetting how this works, then you might very well say, hey, you know, what's going on? Stock market's up, but my portfolio is down. Well, that's why, because you're not in the stock market. And that's just important to understand. So I hope this conversation has helped. I really hope you do understand at this point have a much better understanding of the difference between investing for growth or investing for income. And I really think at the end of the day, it all boils down to a very simple analogy. Imagine for a second that you were a farmer and you have to live off your farm and you have a chicken coop. Do you want to eat the chickens or do you want to eat the eggs? Of course, you want to eat the eggs. And that's what we help our clients do. We help our clients be able to get enough eggs from their portfolio that they can live off of or reinvest. And if you're not eating all these eggs, then guess what? We can save them and we can go buy more chickens. And as you buy more chickens, you're going to get more eggs from those chickens because you've got a fresh batch of chickens. So That's really all we're trying to help our clients do. Invest the old-fashioned way, protect your portfolio, but earn enough dividends and interest to be able to keep pace with inflation. We're not trying to help you get rich. We just want to make sure that you don't lose buying power and that you never go broke. So if you have any more questions about that or anything that I've said doesn't make sense, please don't hesitate to contact us. You can reach us through our website at providencefinancialinc.com. Again, like us on Facebook there. Follow us on YouTube. As life changes and the market changes, I do a periodic market update, and you'd probably be smart to just tune into that and pay attention as things move on. So again, my name is Anthony Zaccaro, founder and president of Providence Financial and Insurance Services. If you're a client of mine, I thank you so much for your business. I thank you for your trust. We don't take it lightly. Have a great day, and God bless.